Next, how do you calculate Forex profits? So the profit you make or the loss you make is equal to the number of pips that you capture. Okay, it moved by 20 pips. It moved by 100 pips. So how many pips did you capture? Multiplied by the number of lots, multiplied by the dollar value per pip per standard lot. Okay, so you understand the number of pips, right? 20 pips, 100 pips, right? You understand the number of lots, right? So one lot, 100,000, two lots, 200,000. Okay, you understand that. Now, what is the meaning of the dollar value per pip? In other words, how much is one pip worth per standard lot? Okay, and the answer is this. The dollar value per pip for each standard lot is usually about $10. Okay, for most of the actively traded pairs like Euro USD, Pound USD, and Aussie USD. Okay, but to get the exact value, you can go to this website over here, which is mtpredictor.com/pip value table to find out the exact dollar value per pip per lot for most of the major currency pairs. So if you go to the website, you will see something like that. Okay, and again, this changes all the time. So you have to get the latest update on that day. Okay, so on this day, when I log in, it's the 7th of October. So as of the 7th of October, you can see that for Euro USD, the value of one pip is, now, this table is based on a mini lot of 10,000. Okay, so we want to look at a standard lot, which is 100,000, right? Which I talked about. So in other words, you have to take this multiplied by 10 to get a standard lot. Okay, so 1 times 10 is $10, right? So all this would be $10. Okay, this would be $8.90, right? And this would be this would be $10.20, right? Just multiply by 10. You understand? Euro franc, this would be $10.20. This will be $8.90. So you can see that for most of the currency pairs, it is straight up $10. All right. So in other words, every one pip movement is $10 per lot that you buy. That's what it means. All right. So let's take a look at an example. So over here, you can see that this pair on the chart is the Euro USD. Okay. And say we believe that the Euro USD is going up. Okay, so when we say the Euro USD is going up, it means that the Euro is appreciating against the dollar. Or we say the dollar is depreciating against the Euro. So when we buy Euro USD, we are bullish on the Euro. We think the Euro is going up, and we think the dollar, the US dollar, is going down. So we go long on the Euro US dollar. Make sense? Okay, and say we go long at 3510. Okay, and we buy one lot. We buy 100,000 of the base currency, which is 100,000 euros. So we key in one lot into the broker, and we're in the trade. And say we are right, and it goes to 3550, and we sell. So how many pips did we capture? We captured 40 pips, right? Because 3550 minus 3510 is 40 pips. And we bought one standard lot, so times 1. If you bought 2 lots, times 2. If you bought half a lot, times 0.5. Make sense? And we multiplied by the dollar value per pip. And the dollar value per pip for Euro USD, which you saw on the table, is $10. Right? So 40 pips times $10 times one lot is $400. Right? So in this case, you made $400. Okay? Again, that is the dollar value per pip per standard lot. Okay? So let me explain the same thing in a linear form. Some people like to think linear. So again, I go long on Euro USD, one standard lot at 3510. Okay, so again, I buy Euro USD at 3510, and I sell Euro USD at 3550. So the difference is 40 pips. Okay, and again, the profits is the number of pips times the dollar value per pip times number of lots. So we've got 40 pips times 10 bucks times one lot, that's $400. Okay. So another way of looking at it is that I'm buying 100,000 euros and paying $135,100. Okay. I'm buying 100,000 euros and paying 135,100 for those 100,000 euros. And then I sell 100,000 euros over here and receive $135,500. Right? As you can see over here. So the profit earned is this and this. So this plus this minus this is $400. Okay. So notice that if you don't use leverage, right, you would have to invest $135,100 or 100,000 euros to earn $400 US, right? So in other words, you're earning $400 US from $135,100. That's a 0.29% return. You may say, that's such a small return. You're not going to buy 135,000 US dollars to make $4. Are you nuts? Okay. That is why in Forex, all Forex traders use leverage. Because if you don't use leverage, it doesn't make sense. Because currencies move very little every day. So for us, we're going to be day traders. We're going to buy and sell on the same day. All right. So to make it worth our while, to have a good return, right, we need to use leverage. In other words, we don't want to put down 100,000 euros in order to make a lousy $4. We want to put in a small deposit in order to buy the 100,000 euros so that the profit over our deposit is a good return. Okay? So most Forex brokers allow you to leverage 1:100. What does that mean? That means for every 100,000 euros, you only need 1,000 euros of deposit to buy that position. Okay? So if you only use 1,000 euros, okay, that means you're making $400 from 1,000 euros, and that's a much better return. Okay, but I can tell you that for us, or for me at least, when I trade Forex, I don't ever use more than 1:20 leverage. Okay, so again, brokers allow you to leverage 1:100, but for the purposes of trading, we will not be leveraging any more than 1:20. Okay, so in other words, for every 10,000 you put into your account as capital, you don't have to buy more than 200,000 worth of any currency. Very rarely, right? Usually, I only leverage about 10 to 15 times. So for every 10,000 I put in, I'm only buying 100,000 worth or 150,000 worth of currency. Okay, so again, if you employ a leverage of 1:20, we just need to invest a margin means deposit, of 6,755, right, or rather 5% of the position size. So our return in this case becomes $400 profit over 6,755, which is a deposit you need to buy 135,000 dollars, and that's a 5.9% return per trade, which is a lot better, right? So let's look at the opposite scenario, which is going short. So in this case, we believe the Euro USD is going down, right? The Euro is depreciating against the dollar. Okay, so we want to go short, and we short Euro USD at 3,560. We short one standard contract, one lot, which is 100,000 euros. All right, and say we are right, it goes down, and we then buy it back at 3,520. Okay, so how many pips do we earn? Okay, so notice in the Forex markets, okay, there are two ways to make money. One way to make money is buy low, sell high, right, which is what we did in the previous example. The other way to make money is to sell high and buy low, right? So it's the same thing, just going the opposite direction, you make the same profits, okay? So in this case, we sell at 3,560, we buy at 3,520, and we made 40 pips. Okay, we made 40 pips. The difference between 3,560 minus 3,520, 40 pips, we made 40 pips, and each pip is $10. We bought one lot, that's 400 bucks. So same thing. So again, let me re-explain in linear form. Going short, Euro USD, one standard contract. And so we sold Euro USD at 3560. And we bought it back at 3520. Difference, 40 pips. Okay? So again, what's your total profits? Number of pips, which is 40, multiplied by the dollar value per pip, which is 10 bucks for this pair, multiplied by one lot, which we bought one lot. Okay, if you bought two lots, we times two. Okay, so we get 400 US dollars. So again, another way of looking at it is that we started by selling 100,000 euros. Okay, and received $135,600. Okay, and then we bought 100,000 euros and paid $135,200. So we bought 100,000 euros and paid this amount, of which we had this amount already. Okay. So the total profit earned will be the difference between this and this, 400 bucks. All right, so we made $400. So again, without leverage, notice that you would have to utilize $135,000 to earn $400. And the return, 400 over 135 grand, it's 0.29% return. All right, so hardly worth our while. Okay, so we use leverage. So instead of putting down 135 grand, if we use leverage of 1:20, that means we only have to put a 5% deposit or 5% margin in order to take this position. Okay, right? So 5% of 135 grand is $6,000. So if $6,000, we can buy this position, or rather sell it and buy it back, and we're making $400. So $400 over, oops, it's too fast. $400 over, let's go back to that. Right, $400 over 6 grand, it's 5.9% return for one trade that takes 1 to 2 hours. Pretty good return, right? So leverage is what makes, what allows us to get a really good return on our trades. Okay, so again, let me just talk a bit more about leverage. Again, in Forex, most brokers will allow traders to leverage 1:100 times. Okay, so that means you can buy or sell 100,000 US dollars worth of currency with just $1,000 in your account. But in most trading situations, we usually only leverage 1:20. Okay, so this means that with a $10,000 account, we usually will buy or sell up to 200,000 worth of the currency at the very most. And that is all that's required to achieve exceptionally high returns consistently. Okay, so notice that based on the leverage, it tells you the margin required. Okay, so again, 1:20 means that we just put a 5% deposit or 5% of the contract size to go long or short on the position. All right, so that's how we use leverage. All right, so let's talk about the different kind of Forex traders. So just like there are so many ways to cook fish, there's so many ways to trade Forex. And there's no the way, there's no the right way. There are many ways. And you can be really successful and really profitable in many different ways. So it all depends on choosing a style of trading that you're comfortable with, that suits your personality, and that fits in with, again, your work schedule or your time schedule. All right. So there are basically 4 kinds of Forex traders. And let me begin with the long term, and then I'm going to go down to the short term, right? So some people are what we call position traders. In other words, they will enter the Forex position and they will hold it for a couple of months or even years, right? They have a long-term view. And normally these people, they will tend to trade based on looking at fundamentals, right? The underlying health of the economy, what's happening to interest rates and GDP, and they look at the overall big trend. So normally position traders like George Soros, for example, when he enters a trade, he will target 500 to 1,000 pips per trade or more, right? So to capture 500,000 pips, you have to stay in the trade for a few weeks to months to even years, right? And position traders, they tend to look at the charts and they look at daily candles, right? So each candle represents one day, or they look at weekly candles. So those are position traders, okay? Next, we have swing traders. So swing traders will typically target 50 pips to about 150 pips per trade. So when they get in, they hit 50, 150, they're out of the trade. And the trade duration usually lasts for less than a week, a couple of days, right? And they'll look at charts with hourly or 4-hourly candles. So those are swing traders. Next, you've got day traders. And day traders, as the name implies, they buy and sell within the day, right? The trade rarely passes over the next day, right? By the end of the day, they close the trade. And so normally, day traders would do a couple of trades a day, right? Maybe 2-3 trades a day. Where swing traders, right, it takes about a couple of days to close the trade, right? So they may not take as many trades. And position traders will take even less trades because their one trade lasts for a few months or even weeks or years, okay? Day traders would look at charts and analyze based on 15-minute candles or 1-hour candles or 4-hour candles. Now, the shortest time frame that people trade are, well, we call them scalpers, right? They scalp the market. So scalpers, usually they enter and exit within a few seconds. So they buy, boom, they sell, all right? And they just target 5 to 10 pips. They're out of the trade. And they look at 1 minute and 5-minute candles, all right? So again, you've got successful traders in all 4 categories. My personal preference that has worked for me where I make the most money consistently is, that's right, I'm a day trader, right? So I usually take anywhere from 1 to a maximum of 3 trades a day, no more than that, right? Because if I take an average of 2 trades a day, which I do, in a month, you're doing about 40 trades, and that's more than enough. 40 trades a month, it's more than enough, okay? And again, my usual target is, like it implies, 20 to 40 pips per trade, and I tend to trade on 15-minute candles. So each candle is a 15-minute time frame. So that is my personal style. So let me show you the charts and show you how this kind of looks like on the charts itself. Alright, so let me show you an example of the different kind of trading styles with the charts, okay? So what I'm using is the MT4 platform, which is the trading platform that most traders use. And most Forex brokers use the same MT4 platform. And in the lesson on technical analysis, you're going to be learning exactly how do you set up the platform, how do you use all the charting software. But for now, I'm just going to show you some basics of how we trade in the different styles, right? So I'm looking at the Euro USD, okay, and the market's closed right now. I'm doing this on a weekend, so you can see that the prices are not moving, but when the market's open, you can see the prices will be moving rapidly, okay? Now, what I've selected is D1, which means daily candles, right? Which means each candle represents 1 day. So that's 1 day, 2 days, 3 days, 4 days, 5 days, so on and so forth. And you can see these red and green candles. The green candles represent bullish candles, which means the price closed higher than the open. And bearish candles where the price closed lower than the open. And again, you'll be learning candlestick patterns in detail under the lesson on technical analysis. So right now, I just want to show you that for position traders, okay, who are long-term traders, they look at daily candles, right? And so what happens is, for example, they may see an uptrend and say, okay, I want to enter the trend. So for example, you can see this is a very clear uptrend over here, all right? And they may say, okay, I want to buy here, right? Buy the Euro USD, and maybe I want to sell it somewhere here, for example, okay? So how long is this, right? So this April, right? April, May, June, July, August, right? April, May, June, July. So it's 5 months, right? So they hold one trade for 5 months before they exit. This is a position trader. To me, it's really long term. And how many pips is that? Well, let's take a look. If you click on this crosshair, okay, and you click on this and you drag. Now, do you notice you can see these numbers? Can you see this 4376? Can you see that? If you drag 4638, 513, can you see that? Okay, so those are the number of pips. Number of pips. So in other words, if you were to buy from here, okay, from here, and you were to sell it here, how many pips is that? That is 6131. Can you see that? Now, 6131 can see is 4 decimal places. Okay, but in this case, the 1 is a fractional pip. So you ignore the 1. You take 613. So this means it's 613 pips. 613 pips, okay? So which means that if you were to buy here, all the way and you sell it there, how many pips is that? That is 1,357 pips, right? Because the 3 at the end, 13573, ignore the 3 because that is a fractional pip. So again, 1357, that's 1,357 pips. So you can see that for a long-term a position trader, right, they're in it to capture 1,000 pips, 500 pips, 2,000 pips. Okay, so to do that, you have to be in a trade for a couple of months. Okay, so that's position trading. So that's not my style, right? You can do that if you want to. That's not my style. Next would be I mentioned swing trading, right? So swing trading is, again, you tend to look at hourly candles as a swing trader. So when you click H1, it's hourly candles. So now it's kind of like we're taking a microscope, we are zooming in such that now each candle that you see is 1 hour. So this is a 1 hour candle, 1 hour. So each candle takes 1 hour to form. Okay? So as a swing trader, okay, you can look at the hourly candles, 1 hour or 4 hour candles. 4 hour candles, right? Where each candle represents 4 hours. So for a swing trader, they may take a slightly longer trade, okay? For swing trader, they may, for example, trade from here. I can see an uptrend. You can see this uptrend here, right? And then this consolidation going sideways. So they may take a trade. For example, they may buy somewhere here, okay, and yeah, they may maybe sell. Let me take a look. 3, 5. Yeah, in fact, shorter than that. So for swing trader, let me zoom in a bit. Okay, so they may buy somewhere over there, and they may even sell just there. Okay, so they captured about 100. Okay, you can see 1315 at the center. So that's 131 pips. All right, so they captured 131 pips. They're out of the trade. And again, from here to there, they buy and sell there. It took a couple of days, from the 5th of July to about the 11th of July, right? So that's about 5 days, 6 days, right? So that's a swing trader, right? So the trade lasts for a few days, okay? They look at 4 hour, 1 hour candles, okay? Next, so let's go down. We have got position trading, we've got swing trading, and next we day trading, right? Which is what I do. So I'm a day trader. And as a day trader, I tend to use 15-minute candles, right? 15-minute candles. So now it's like I take a microscope, I zoom in even further down, and each of these candles you see over here, okay, these are 15-minute candles. So each candle represents 15 minutes, 15 minutes, 15 minutes, right? So as a day trader, I will usually go for 20 or 30 pips and I'm out, right? So I could, for example, again, you notice that, there's a nice trend here going up, trend going down, right? So reverses up, and I could take a trade here somewhere, for example. I'll teach you, again, on the lesson on the strategy, right? The impulse pullback, impulse pin bar, I'll tell you exactly when to get in based on the moving averages, support resistance, candlestick patterns. So I'm not showing you the exact strategy right now. I don't want to confuse you. I'm just showing you, how many pips we capture, right? So I could enter here, for example, as a day trader, and I capture something like about there, right? I can see 242 at the center, so that's 24 pips, right? So I buy somewhere here, all right? I buy somewhere here. Oops, buy somewhere here, and there I'll sell somewhere here, right? So I buy here, I sell there, I get 24 pips. That's it. I'm out, and I go for the next trade. I may buy here and sell there. All right. So I'm capturing the very short-term trends within the day. So you can see that this trade from here to here was within the same day, within the 3rd of October. So how long did this trade take? It took 1, 2, 3, 4. Right, one candle is 15 minutes. Right, so 4 candles is 1 hour. So 1, 2, 3, 4. That's 1 hour. 1, 2, 3, 4. 2 hours. 1, 2, 3. Half an hour. Right. So this trade lasts for about 2.5 hours. That's it, and I'm out of the trade. So this is day trading. Right. And finally, you've got scalping. And scalping I don't do because it's too fast-paced for me. Right. It's too stressful. Right. I don't like to be a scalper. But scalpers, they may use 1-minute candles or 5-minute candles. Right, so they may use a 1-minute candle, and it's kind of like you zoom in even further with a microscope, all right, and you can see that each of these candles are 1 minute, right? They take 1 minute to form, and the scalper may buy here, right? They may say, hey, okay, there's this sideways, the trend going up, right? So they buy here, and they get maybe like 10 pips. I can see 103, right, in the center, so that's 10 pips. So they buy here, they get 10 pips, boom, they're out, they sell, right, and they get in again, they sell again, they get in, they get sell. Really stressful, you can do a lot of trades a day, not my style, right? So again, I'm a day trader, and hope this gives you a better understanding of the different kind of traders, okay? So let's move on to the next part. All right, so let's run through the entire trading course curriculum. And you should be able to finish this course within a week. You can look at 1 lesson a day and then practice it. It'll be ideal, it'll be optimal, right? And do practice it as you learn. So lesson 1, we have just coming to the end of lesson 1, where it's the introduction to Forex trading. I do hope now you've got a pretty good understanding of what Forex is all about and how we trade it, okay? Lesson 2, we'll be going to next, where you're going to learn the secret to achieving consistent trading profits. And it's based on statistics, based on mathematics, right? You'll be learning the statistics of, again, consistent profits, how to achieve consistent profits from random outcomes, right? In a short run, price movement is pretty random, but there are repeatable patterns that we exploit in the markets to create consistent profits over a number of trades. You'll be learning exactly how to trade just like a casino. The casino is playing a game of chance with the players. But a casino always wins at the end of the day because they've got an edge over the players mathematically. You will learn the principle of how casinos do it and implement it into your trading routine. And how do you develop a trading system with a positive expectancy in the markets. Next, in lesson 3, we're going to technical analysis, which is the main tool I use to get an edge in the markets, to anticipate price movements. You'll be learning about the foundational principles of TA. We'll cover candlestick patterns, how do you identify trends, how to utilize support and resistance levels, how to master moving averages, and how to use the trading platform. And we're going to be using the MT4 platform, which is the most common platform used by traders. Okay, lesson 4. Lesson 4 is all about position sizing, risk management. How do you manage your money and size your positions? How many units do you buy? How many contracts do you trade? And how do you automate your trading business with order management techniques? So your entries and exits are automated. You don't have to be there. Takes your emotions out of the equation. Okay. Lesson 5 and lesson 5 will be the first lesson where you'll be learning the actual strategy, where we put everything together into a system. Okay, a system that will generate consistent profits. And the first strategy you will learn is the impulse pullback strategy. Okay, so you'll be learning about specific price action patterns you'll be using for this strategy, entry and exit rules for long setups and short setups, how do we filter to take only the highest quality trades, and how do you manage your trade, right? How do you exit the trade? How do you enter the trade with precision? Okay. Lesson 6, really important, psychology of winning traders. So how do winning traders think differently from the herd? How do you manage to overcome negative emotions that will impede your progress as a trader, that can sabotage you? Okay. How do you manage temporary drawdowns in your capital, which is inevitable in trading? And how do you program your mind to become a winning trader? Okay, so in lesson 7, you'll be learning the next strategy, which is the impulse pin bar strategy. This is another very powerful strategy that I use with really high win rates and expected profits. Okay, you'll be learning about the bullish and bearish pin bar and specific price action patterns that work with this strategy, exact entry and exit rules for long and short setups, how do you filter for the highest quality trades, and again, trade management and exit strategies. Finally, to cap it all off, lesson 8, developing a trading plan. Just like any business needs a business plan, as a trader, as a professional trader, you need a trading plan to guide you. So you'll be learning how to develop such a trading plan, and you'll be learning about my daily trading routine that takes 3 to 6 hours a day, or even less, okay? How do you keep a trading journal to record your progress and to keep improving with each and every day? And we'll also talk about how do you choose a forex broker with really tight spreads, low commissions that can really help you in your trading journey. Okay, so that concludes lesson 1, and I'll see you guys in the next lesson. To revise what you've learned. If you've got questions, send me an email. I'll be happy to help. This is Adam Koo signing off, and I'll see you in the next lesson.